everyone. I'm Andrew Constantinidis, an advisor with Jesani Wealth Management. And one of the core principles or one of the assets in our multidimensional asset allocation is, in fact, structured notes. So I wanted to kind of walk through some of the risks involved in structured notes. What are the negatives? So what are you giving up in order to get you something that may potentially have less risk or less volatility than the overall market or investing in particular stocks? So first, I'm just going to pull up a graphic that I like because it really draws a nice picture of how a structured income note works. Now, there's really two main categories of structured notes. There's notes that are meant to pay a dividend or an income note. So when you purchase the note, the bank that's issuing it offers a predetermined interest rate, and that's all you're going to get. You'll never do better than that. So let's say it's a note that pays 10%. You're going to get your contingent upon the underlier, your coupon, either monthly or quarterly of 10%. You'll never get more than that. And then you get return of principal on the maturity date of that note. The other main type is a growth note, which come in many different shapes and sizes, but essentially you don't get any income, so it doesn't pay a dividend. Its sole purpose is to generate growth, potentially leverage growth or better than that of a major index, and potentially with protection to the downside, but also really contingent, and it can get quite complicated and be contingent on a lot of different factors in the market or the performance of that underlying equity or the underlying index. So let me go ahead and pull up the educational deck that I like to use. So this is just showing you big picture how a structured income note works. So I'm going to start over here. You see SPX and RTY. So any note that you buy is going to be based on either an index or a stock or an interest rate, something that is measurable and that is trackable in the world of investments. So this is just showing a scenario where this note is based on the S&P and the Russell 2000. So the note has a 3-year term. Of course, you can get notes that are 6 months, 1 year, 18 months, 2 years, 3 years, 5 years, 6 years, all the way out to 10, or I've seen 15 years. So this is just showing a 3-year note broken down quarterly. Now this note, when we bought it, and this isn't an actual note, it's just an educational deck, but this is showing a coupon of 6% per year. So you can see every quarter here, you're getting 1.5%. So at the end of the year, you've collected 6% in coupons. Now that coupon that you're getting on an income note is contingent on the underlying indexes or equity, whatever it was initially tied to when the prospectus was issued on that note. So this one is the S&P and the Russell. So it's recorded what the level or what the value of those indexes were on the trade date, the date that the note began. After that trade date, you can see that you get your coupon as long as those indexes don't trade below this red line, this is called your barrier or European barrier. There's also buffers, which I'll talk about in this video as well, but this is showing a 30% barrier. So what that means is you get your coupon as long as neither of these two indexes go below this barrier or go down more than 30% from what their value was on the date that you purchased the note. So you can see that the S&P trades up and down and up and down, and it actually closes after 3 years at a level lower than it was when you initially purchased the note, but not down more than 30%. And the same is true for the Russell 2000, lower than where it was when you purchased the note, but not below 30%. So in this scenario, since it never dipped below that barrier, you would get all of your coupon payments. So every quarter you're collecting this 1.5%, and on the maturity date, let's say you put $100,000 into this note, you would get your $100,000 back, and you would add a 6% return every year over a 3-year period. So now I want to kind of play out the scenarios where you may miss a coupon or you can lose principal and what the risks are in a note. So this is basically the same picture we were just looking at, except in this illustration, you can see that here in quarter six, one of the two indexes, it looks like it was the Russell, went down more than 30%. Maybe it's down 32% from its level from where we purchased the note. So you can see in this scenario, because one of the two, and it can be either of the two, went below that barrier, we did not get our coupon for that particular quarter. We get nothing. But then the next quarter, it came back above that level, and we began to get our coupons of 1.5% again. And then at maturity, again, they're both down. It looks like maybe the S&P is down, 25 and the Russell's down 28, but not below that 30% level. So again, we get full return of principal, or you get your $100,000 back. All we missed here with this volatility in the markets was one coupon payment of 1.5%. Now, what is the risk of principal, which is always the most important, because it's not, especially if there's a lot of volatility in the markets, missing one coupon payment is not going to have a real tremendous impact on your overall portfolio. But what we don't want is to lose principal. But first, let me discuss how a note can get called. Now, if we buy a note, almost all notes are callable. All income notes are callable. Growth notes are not callable, which I'll discuss in more detail, but income notes are callable. And what happens is, let's say we buy a note and the indexes go up and up and up and up. Well, you can see that here in quarter five, now the S&P is much higher than it was when we started. So it would need to go down much more than 30% to get below what was an initial 30% barrier. So what the bank will do is they're able to call the note. Now, typically, a note will have a no-call provision of either 3 months, 6 months, or a year. So you're guaranteed to stay in that note for that period of time and collect the coupon. But the downside to a call is, well, the bank gives you full return of principal, and of course you get all your coupons for the time that you've had the note. But what we then need to do is replace that with another note, which we'd be purchasing with the index or the equity at these higher levels. Which provides, more volatility, the downside potentially. Now, when I mentioned loss of principal, this is a scenario where you'd lose part of your initial investment in a note. So again, we have a 30% barrier, S&P and Russell 2000 on a 3-year note. You can see again that quarter six, when the Russell dipped down more than 30%, we missed our coupon, then they recovered. But on this one, on maturity, at that one maturity date of the note, 3 years from the date that we bought it, you can see the Russell is down. Let's just say this is down 32%. So in this scenario, just like you were in the index, you would lose 32% of your principal, thus getting 68% return of principal. Now, if you lose principal in a note, the bank just returns the difference of what they owe you. Of course, now during this time, let's say we lost 32% at maturity, we do keep any coupons that we got throughout the term of the note. So you get protection up to a certain level, and once it breaks that level or barrier, you participate in one-for-one in the losses. Now, I may talk about this in a few minutes, but there's also something called a buffer. Now, let's just say the same scenario was true, but this was a 30% buffer, and the Russell was down 32%. In that scenario, instead of losing 32% like you do in a barrier, you would lose 2%. So you don't, a barrier, you're kind of falling off a cliff, whereas a buffer, you're buffered for the first 32%. So if we're down 32, we're down 2. If we're down 40, we're down 10%. Now, of course, the terms offered on a buffer note aren't going to be or the interest rates offered on a buffered note aren't going to be as generous as the yields or terms that may be available in a barrier note, because of course your risk of principal is much lower when you're talking about a buffer. So I'm going to go and flip over to a presentation I have here that kind of walks through some of the benefits and the risks of structured notes. So I'm going to start with the risk considerations that you should think about when you're purchasing a note. So the first one is credit risk. So structured notes are issued by all the major banks. Let me actually pull up a quick snapshot of the banks that we're using right now. So here are the banks that we use for our structured notes. You can see banks that you're familiar with: international banks, Goldman Sachs, Morgan Stanley, HSBC has great notes from time to time, Wells Fargo, Citigroup. They're all highly rated bank. However, that doesn't mean that one of these banks could go out of business. So the banks have no skin in the game when they issue a structured note. They're using complex options and derivative strategies to create that note. So it's really just an obligation of the bank. It's the bank that's saying, I will pay you 8% on this particular note throughout the whole term, contingent upon the underlier not going down or sometimes even up a certain level. So it's an obligation of the bank. So probably your primary or your main risk is if the issuing bank goes out of business. But you can see we've minimized that risk in a few different ways. One of them is using the largest banks in the world, but the second way is we'll typically ladder in or diversify among several different banks within a client note portfolio. So let's say we have $2 million just in the structured note portion of a portfolio. We may have 100,000 with Citigroup, 150 with Wells Fargo's notes, 250 in Barclays notes. BNP Paribas, the ninth largest bank in the world, will have some of their notes in there. So we typically try to diversify as best we can among different issuers or different banks. So going back to the risk factors, second one is the market risk. Now that's the risk that we were looking at before of the S&P or whatever the underlying index or stock is going below the barrier. Because theoretically, you could lose 100% of your investment in a note. So let's kind of play that out. Let's say you just purchased a note on Tesla, for example, that pays you a coupon as long as Tesla doesn't go down more than 30%. And let's say it's a barrier. And let's say Tesla goes to zero. Well, in that scenario, you would lose 100% of your principal. That would be a very high risk note. And just looking at what's available in the market today, a note like that would probably pay you an interest rate of probably somewhere between 25 to 40%, depending on the issuing bank. But that certainly is a risk, the market risk. If you invest in that note based on the S&P and the Russell, and one of them is down 32%, you could certainly lose 32% of your principal. The next is your secondary market risks. So a question that we get a lot is, are these notes liquid? Because as you saw before, there's a term that's assigned to the note. Again, it can be anything, and it's determined at the beginning of the note, so you know what term you're getting. We will typically ladder in different maturities in a note portfolio. So we may have some that come due 1 year, some that come due after 2 years, 3 years, 4 years, and 5 years. But if you do want to sell a note before maturity, you can either go into the secondary market and sell the note through a broker, or in most scenarios, the issuing bank is actually buying that note back. But it's very important to understand that the market value of that note that you hold will fluctuate based on where that underlying index or stock is trading. So let me go back to the original illustration and show you what I mean by that. So let's say we buy this note again on the S&P and the Russell, and you can see here the S&P went up in after 6 months. Well, in this scenario, the note that you bought for a par of 100 is going to be trading higher than 100, maybe trading at 103, 104. So if you sold that note, you could indeed make a profit or a capital gain on the sale of that note. The same is true on the downside, though. Let's say over here, we want to sell this note when both of these indexes are down. I don't know, it looks like one is down 15 and one is down 25. Well, that note is going to show in a portfolio and trade at a discount, kind of similar to a bond of 20 or 25%. And you would really be defeating the purpose of having a structured note if you sold a note when it's down. Because let's play out the scenario. You have a note, it shows you're down 20% in your portfolio, but in reality, we're not below the barrier, and we purchased this note with a 30% barrier, so we have protection up to that level. So if we sold it, we'd be taking a loss in a note that doesn't mature for 2 years, We're not even below the maturity barrier. In this scenario, we wouldn't be below the coupon barrier, so we'd still be collecting our coupons. So you really only want to buy notes that you fully intend on holding till maturity. And again, let's say the note is up on the S&P and the Russell, and we sell it and we make a gain. Well, similar to if the note was called, we now need to go out and replace that note, and we're buying a note with index starting prices at much higher levels than the initial note that we bought. So they're really meant as an instrument to hold until maturity. But if you do want to sell a note in the secondary market or back to the issuing bank, it's certainly possible. But just remember, the price you're going to get can be higher or lower depending on the underliers. The next one is call features, which I kind of discussed before. The bank can call the note. Then our job as an investment advisor is to go out and find a new note to replace that. Of course, for foreign currency risk, there are notes that are designed and contingent upon the trading prices of international currencies, and then legal and tax considerations. Let's say it's an income note. Of course, that if it's held in a non-qualified account or a brokerage account, that is going to go right onto your income for the year, those interest payments that you're collecting. Or if it's a growth note, which I'll talk about in a moment, and you have a capital gain, that you're going to be taxed on capital gains from that note. And then fees and costs. So we're an investment advisor. So just to kind of discuss the notes that are offered through stockbrokers versus investment advisors, we charge an annual fee for the management of our total client portfolios. We act in a fiduciary capacity. So there's really no other fees in the notes that we offer our clients. However, let's say we have a note on the S&P paying 12% with a 30% barrier. That the bank issues that same note through a broker dealer, where the broker dealer gets a commission of 3 or 4% to recommend that note to a client, but the yield is going to be much lower, maybe 7 or 8% with the same barrier. So it's typically a little bit better for the client to invest in structured notes through registered investment advisors or fiduciaries. Now, in the offering documents of the prospectus, you will see that there is typically a fee anywhere between 50 to 75 basis points that the bank is charging to issue those notes. However, that is included in the end interest rate that the client is getting. So let's say it's a note, again, 12% on the S&P. The fee is built into that note. So you're not getting 12% less the 50 basis or 75 basis points fee. You're actually netting your 12% return, less, of course, the income taxes that you may pay on that. So just kind of some of the benefits and why notes could make sense right now is stocks keep reaching higher highs. So what does that mean? So it can be challenging to find undervalued sectors of the market or undervalued equities that you think are going to go up 10 or 12% every year for the next 5 years, where you may be able to find a structured note based on that group of equities or that index that's going to offer you 10 or 12%, whatever it may be, where that stock doesn't necessarily need to go up every year. It just needs to stay above a certain level. The other one is the global economy, it continues to improve. Well, we're in July 15th of 2022 right now, and we've actually seen a really significant sell-off in the markets, and we're on the verge of what could be a 2 or 3 year recession. So what does happen is when there's volatility in the markets, the yields on the notes tend to improve. So 2 years ago, when the market was relatively stable before COVID-19, the yields on an index-based note like the S&P and the Russell was 7 or 8%. We're now on those same notes, we're seeing 12 or sometimes even 13%, of course, depending on the barrier. So now I want to kind of talk about what is a structured product. I mentioned that those major banks are using options and derivative strategies to create those notes. they're typically linked to an underlying equity index, an equity or interest rates or commodities. The example I used at the beginning of this was just based on equity index, the S&P and the Russell. The same principles come into play no matter what the underlying what the underlier is on that particular note. Debt obligations of large global banks, which I discussed. So your credit risk from that bank is certainly one of your primary risks. Limited liquidity, which I kind of discussed earlier. So it may be difficult to sell a note in the secondary market. And if you can sell it, you may get less than you paid for it, depending on where the underlying index or commodity or currency is trading at. So there is a lot of flexibility in notes. Every month, there's thousands and thousands of notes offered by the major banks on pretty much any index, equity, or ETF you can imagine. And we also are able to create our own custom notes. So what I mean by that is, let's say we like a particular stock, like Johnson & Johnson, and we're interested in potentially buying that stock in a client portfolio, but the market looks like it's going to go, it looks like it's going to be flat, or we may not see a great year in the market. So instead of buying that stock, we can reach out to all the major banks and say, hey, we would like to see a structured note based on, let's say, Johnson & Johnson, maybe Bristol Myers, those two stocks with a 20% barrier or buffer to the downside. What interest rate or annual rate is available on those notes? And let's say they come back and say 10%. Well, then we need to ask, so let's say we buy the stock, what return would we be happy with every year for the next 3 years? And if the answer is greater or than 10%, then a note may not make sense, because that means we're looking for a return of 12, 14, 18%. But let's say the overall return of the S&P is usually about 7%, maybe a little bit less. But let's say we would be happy with an 8% return by buying those stocks in the open market, and we can get a note that is paying 10% with the barrier to the downside, meaning those stocks can go down 5, 10, 15, 19%, assuming we have a 20% barrier, and we're still generating that return with no risk of losing principal. So we do design our own custom notes. We do have clients that reach out to us that are interested in particular equities, and we are, as an independent advisor, able to look at all the major banks, and we just go with whichever bank is offering the best yield at that particular time. And it is interesting. It seems like the banks, they kind of go one after another. You may see a few months where BNP Paribas is consistently offering the best terms, and then after that, Bank of America has really great terms for a month or two, but they're very competitive in that way. So usually one bank is offering far better terms than all the others, which is nice, because let's say I was an advisor at JP Morgan. Well, I'm only going to offer notes to my clients, or the bank is only going to let me offer notes that are created by JP Morgan. Or if I'm an advisor at Wells Fargo, we're going to be using notes from Wells Fargo, whereas an independent advisor, we're able to just use whatever's best for our particular client at that particular time. So at this point, most investors are familiar with structured notes. They've been around for 30 or 40 years, and originally they were built primarily for the major institutions and pension funds. Over the years, and particularly from 2005 to 2015, notes became a much more predominant part of the retail investor's portfolio, and now you can see the volume is quite significant in the past 3 or 4 years throughout the world, not just in Europe and America. You can see it has continued to go up even since 2017, and I would expect that as notes become more available and more retail investors learn that these products are available, I think we'll continue to see the volume of notes being issued continue to grow. So, what's the role of a note in a portfolio? Well, I can say you certainly shouldn't have a portfolio, or we don't believe, of only structured notes. These they we look at them really as an equity replacement. So the equity portion of your portfolio is typically going to be the higher risk, more volatile portion of your portfolio. Now, that being said, a way to supplement the performance of that may be to include structured notes where you're limiting downside but still getting upside potential or growth in the market, which we're kind of getting into growth notes here. So let me explain how a growth note works. So we're kind of switching gears and going from an income note that pays you a predetermined interest rate to a structured growth note. So a lot of the principles remain the same, except that, of course, you get no coupon. So what we're looking at is an example of a buffered growth note with a 20% buffer. And if you remember the difference between a buffer and a barrier at the beginning of this presentation. So again, a growth note can be based on any index or individual equity. So we're using the S&P as an example here. So this is a 5-year growth note based on the S&P 500. And the way that it works is you get a leveraged participation on that index. In this scenario, it's 1.2. Now, right after COVID-19, when the overall market declined over 30%, banks were offering 180, 190% leverage on the major indexes with 30 or 40% barriers to the downside. When this presentation was put together, it was about 120%. But again, right now, and it's ever changing, but the banks are offering around 140 to 150%. Now, this is showing a 50% cap. We typically don't use any caps, and there's plenty of notes available out there that have no cap on your participation or the upside. So meaning, let's say the S&P after 5 years is up 100%, you get 120% of that with no cap. But let's just kind of play out what could happen after the 5 years on this particular note. Let's say 5 years out, the S&P is up 10%. Well, your return is going to be 12% because you get 1.2% of that, or 120%. Let's say the S&P is up 60, your return is going to be capped in this scenario at 50%. But going back to we don't typically use caps. So if we took out the cap here and your return is 60%, you're going to be at 120% of 60%. Or if it's up 25%, your return is going to be 32%. Again, 120% of the overall return. Now, it's very, very difficult to outperform the major indexes. That's really what any money manager or hedge fund wants to do. So this does present an opportunity where you can get a better overall return than the index. Now, of course, the downside is you're not collecting the dividends that the major indexes may be paying, and it's a 5-year term. Again, you can sell them in the secondary market, but the price that you get is going to be based off of where that underlying index or stock is trading at. So I explained this scenario and what happens with the leverage on the upside if the index is up after the term expires. But what if the index is down? And again, we look at hundreds of notes every month. So they're available in 20, 30, 40, 50% buffers, 20, 30, 40, and 50% barriers. This is just showing a scenario where we have a 20% buffer to the downside. So let's say at maturity, the S&P is down 19%. In that scenario, or down up to 20%, you would get 100% return to your principal. You wouldn't make money, you wouldn't lose money, but you would have no loss in that scenario. But once we go over that buffer level, you lose 1% for every 1% the index is down over the 20%. So let's say we're down 22, you're going to lose 2% of your overall initial investment. Let's say we're down 30%, which is showing right here, you would lose 10% since you're buffered for that first 20%. So I hope this gives you kind of a general sense of how the notes can work. And now what I want to look at is kind of some of the landscape of structured notes and what's available right now in the market today. So we're in July of 2022. So just to give you a sense, here's a note from Bank of America. This is an income note. It has a 5-year term based on the 3 of the major indexes, the S&P, the Russell, and the NASDAQ. Notice there's no Dow in there. And this note pays you 8.5% with a 50% barrier for the coupon and at maturity. So to not get this coupon anytime during the term, these 3 indexes, any of them, would have to go down more than 50%. And to lose principal on this note, one of those 3 would have to be down 50% on the maturity date 5 years from now, which brings up an interesting point. When we're talking about the index, we have all the historical probabilities. So you may be wondering, well, what's the historical probability that one of these 3 indexes is going to be down more than 50% 5 years from now? So if we go here, so this is showing the worst of the S&P and the Russell. So that would be like the illustration I was showing at the beginning, a note based on the S&P and Russell. What's the probability that one of those 2 indexes, let's say we have a 30% barrier, here's your barriers, what's the probability that one of those 2 will be down more than 30% in 3 years? 4.62. Well, what if we go out more time, 30% in 5 years? So the probability of losing principal historically in a note based on the S&P and the Russell with a 5-year term and a 30% barrier or buffer is 0.25%. And you can see those numbers get even lower when you have 50% barriers like this Bank of America note that I was showing you just a moment ago. So if you want to kind of consider some higher yields or individual stocks, I think I mentioned Tesla at the beginning. Here's a note issued from BNP Paribas. It's an 18-month term, only based on Tesla stock. This note pays a 23.16% coupon, and you can see it pays that quarterly or monthly, again with a 50% coupon barrier and a 50% principal barrier. So if Tesla dips more than 50% anytime in the next 18 months, we miss those coupons. And in 18 months at maturity, if Tesla's down more than 18%, we would participate in losses. If it's down 52, we lose 52% of our principal. So similar to what I was saying before, we can create a note on any stock. This is just, here's one on the SPY, which is basically the S&P 500, Apple, and Johnson & Johnson. So a little bit less volatility maybe than a note just based on Tesla. You get 300% leverage on those, and that's with a 20% buffer. Here's a 2-year note that JP Morgan's offering right now, Apple, Amazon, Tesla. And let's say we were interested in purchasing this note for our client portfolios. We would then reach out to all the banks through our partner and say, we're looking for Apple, Amazon, Tesla, who's offering the best terms. Just so happens JP Morgan right now is offering a 30% annual return as long as none of these 3 stocks go down more than 40%. This is saying a 60% coupon barrier, but the way that I'm describing it, the level of protection is the opposite of what it shows here. So you have a 40% protection, meaning one of these 3 would have to go down more than 40% to not get a coupon, or at maturity, one of those 3 would have to be down more than 40% to lose principal. Here's another index-based income note from TD Bank, a 3-year note. So we have S&P, Russell, and NASDAQ again. This one pays 11%. Now, the first one I showed you was 8.5%, but both barriers were 50. On this one, the principal barrier, so the one that comes into play on the maturity date where you can potentially lose money, is still 50%. So at maturity, 3 years from now, you'd have to be down more than 50, but your coupon barrier is not so generous. It's 30% in this scenario. So if any time during the term of this note, one of these 3 stocks goes down more than 30%, you don't get a coupon, and then at maturity date, we'd have to be down more than 50 to lose principal. Here's another feature that we like to use for our clients, so I just kind of want to walk through it briefly. Here's a note from Goldman Sachs, a 3-year note, similar to the one that we looked at a moment ago that paid a 30% coupon. It's Apple, Amazon, and Tesla. We have a 40% coupon barrier, a 50% principal barrier, but see how it says 1-star feature here. So what's that mean? That only comes into play on the maturity date of the note. Now, as I've kind of discussed before, usually in any other note that doesn't have the 1-star, if any of these 3 stocks is down more than 50%, like let's say Tesla's down 51, we would lose 51% of our principal. What the 1-star feature means that as long as one of these 3 stocks or these 3 equities is higher 3 years from now at maturity than it was on the date that we purchased the note, we will get full return of principal on that note. It doesn't matter if the other 2 are down 90, 95, or even 100%. So either they're all down, but none of them down more than 50, or 2 of them can be down well through the barrier, but as long as one of them is higher by a penny, you get full return of principal. So it brings down the risk exposure of losing principal at maturity on that note when you have the 1-star feature. There's also notes with memory feature that we use quite often. So memory means, remember if we break the coupon barrier during the term, let's say the stock or the index goes below the barrier and stays there for 6 months, so we miss either 6 months or 2 quarters worth of coupons. Well, if a note has a memory feature, on all notes, when it comes back above the barrier, we start getting coupons again. But with the memory feature, you also get any coupons that you may have missed throughout the term of the note. So you get all the backed coupons that you missed. So this is just a general overview of structured notes. The market is changing every day and every week with what's available. Again, we like to use a lot of custom structured notes for our clients based on specific equities that we've determined may be undervalued, and to take advantage of the growth in those equities while also mitigating the downside risk. Structured notes can also get much more complicated than the ones I've described. I've been talking about your basic income and growth notes. There's also dual directional notes. There's a lot of caps that can come into play. But typically in the markets that we're in right now, the basic income notes based on either equities or indexes can be quite attractive, or the growth notes, depending on the timing of the market and where we are in the cycle, with the leverage and, again, the barrier or buffer protection to the downside. So if anyone ever does want to learn about what notes are available right now, or see the current offerings, or see what we're using for client portfolios at the moment, certainly reach out to me. My name is Andrew Constantinidis at Jesani Wealth Management, and my email is either andrew@neiljesaniwealth.com, or the phone number is 954-800-8552. Okay, thank you, everyone. Have a great day.